I've been telling quite a few different people that when you begin to understand how money works, it all becomes the same conversation throughout the entire United States. But one of the conversations that I realized that we're not having 100% of the time is making sure that people understand the power of financial literacy. If someone's actually invited you tonight, it's primarily because they wanted to make sure that you got access to some information that would give you a tremendous amount of information to how to become literate in certain forms of opportunities and information. And tonight's presentation is about the ultimate wealth building strategy. One of the reasons why this is one of my favorite is because I have not only the pleasure of being able to work here on this platform, Our Infinite Company. I've been doing that for about a year and 9 months, going on my second year, actually this coming July. But my previous experience has been corporate America with Citibank, and then after Citibank, a little bit more entrepreneurship. And one of the places that I got my entrepreneurship bones was in the real estate space. And my real estate experience comes from the idea that I not only learned how to service individual clients that were first-time home buyers trying to buy what they call their dream home, then helping individuals who own those homes to actually sell it when they were prepared to move or transfer. But then one of the places that I learned very quickly that there was a tremendous amount of entrepreneur opportunity was learning how to invest in property. And when you learn how to invest property, you get a chance to, in my case, shadow, providing opportunities to investors first. And through seeing other investors learn about how to leverage property itself, they started to understand how they can make money. And I want to actually give you guys what I call a quick comparison between what they call an index universal life policy account and real estate. And one of the reasons why I tell people I've become very clear that literacy is important. I spent more than 10 plus years in the real estate space, not only helping people, but personally becoming an investor myself. In the last 2 years, I've spent a lot of concentrated time in the ability to help expand financial literacy. So I've been in the financial space from Citibank to here now about more than 15 plus years. And tonight I want to make sure that you're walking away with some solid information that's going to position you. And I hope you have the ability to take notes because I'm going to do what I call the pros and cons of building wealth through real estate versus an index universal life. And one of the first things that got my attention was when I was sitting down having a value added conversation. One of the things that somebody brought to my attention was like, well, what is actually wealth to you? And before I responded, they responded and answered that, hey, wealth is the byproduct of your money making you more money. Meaning that if before we answer some of the questions tonight that we're going to go through, which is what are the challenges of real estate investing? How does a potential index universal life, that's what an IUL is, could potentially create a better cash flow solution? Because real estate investing is really the idea that you want to create more income. But the other thing I'm going to answer tonight is can an IUL complement and even replace real estate for a wealth building strategy? But when I started to study wealth a little bit more deeper, everyone, I really began to understand one specific thing is that, hey, everybody in America understands money in a couple of different ways. And there's only three real ways in America that you'll understand money. First, the most introduced option is for you to develop an income. And when you do that, that means because you're going to go to some sort of W-2 or some job, part-time, full-time, which is absolutely nothing wrong. I started in the same space, but I understood that the only thing that you can do through a job is actually produce income, which means that you're going to trade a certain amount of hours based on your salary or your dollar per hour, and you're going to actually receive income for the time that you traded. But the other way people make money in America is through the process of making a profit. The way that that works is that if you actually make more money than the expenses you have in a particular business, so if you're running a real estate business and you have more money coming in than the actual expenses itself, then you can actually make a profit, which is the second most popular, if not more than ever lately. Maybe people are all interested in business, but it's actually the second form of the most known form of money. But maybe a little bit less known to everybody is the process of wealth. The process of wealth is literally where you say, hey, what do I do with my income and my profits so that I can actually make more money? And you just have to plant it in the right soil. So when I was in the real estate space, I understood the business of real estate, but then I understood that if I took my profits from my commissions and the opportunities that I had, I could actually invest it in property to literally make some more money or to make more profits or to make more income. So, but when I got introduced to the concept of an index universal life, I understood that there was another option to make more money or to make more income if you understand how to position that solution. But before we go into what an index universal life policy is, let's answer the question about real estate investments. It's essentially now for a lot of people in America, a very popular way for people to actually build wealth, either through the process of owning a property or managing it or potentially selling it. But here's how it really works. Well, this is how I understood it. Somebody would come to me as a realtor and they would say, hey, Hans, I'm looking for a property, whether it's for their personal resident. But most likely, when I was dealing with an investor, they were looking to make more money. And they would say, hey, Hans, I want to purchase a property. I plan to hold the property and I'm going to turn it into a rental income. So maybe the most common thing that became a natural conversation where I live in the state of New Jersey was I need to find myself a 2 or 3 family. I need to find myself a 2 or 3 family. And what investors would do is literally, or myself as an investor today, we would find that 2 or 3 family property and we would say, hey, that's not our primary residence. We're going to rent it out to someone else so that they can help us pay the mortgage, pay the insurance and taxes that are tied to it. And then whatever is left over is the rental income. So most people in the real estate space, outside of the different techniques that they may have today, they're either going to be generating money through rental income or what they call appreciation. Or maybe they use the word equity instead of appreciation. So you can either buy a property to hold it and rent it out and make yourself a monthly income that way, or you might buy a property at a great price, fix it up and create some value and sell it for its appreciated value, or you might hold it over a course of time and to sell it because you bought it at a great price and traded for its equity. But here's how it really works. You're going to find that property, and you're going to actually put a down payment on it. And essentially, the only other way for you to actually get it outside of your own cash is that you actually have to get yourself a loan. They call them mortgages. And that's how you literally begin to expand your portfolio. As you put a down payment down, you literally position the property in the right location to be rented. And then you go get another mortgage so you can actually be able to control the property and be able to create income. So common real estate strategies are what they call buy and hold. Somebody says, hey, I'm going to buy a property that is 2 or 3 for a family, and I'm going to hold it for a period of time. I might hold it for 2 years. I might hold it for 3 years. I might hold it for 5 years. Some people hold it because they're going to generate income and then they're going to sell it at a future value that they believe that they can collect the appreciated value. And one of the ways that we could do that very quickly outside of buying and holding a property is that literally you can find a broken down property that needs to be fixed, but your intent is 6 months later or 9 months later, you're going to flip it because you got to go through the repair process because maybe when you find it, it might be in a great neighborhood. It might be in a great location, but it's in significant disrepair or somewhat a level of disrepair. And so people will increase the value by putting new windows. They'll put siding on it. They'll have an electrician come in and they make them brand new. They put the brand new doors on it and they can literally sell the property based on the appreciation that they got from it after they fix it and they flip it. And you can make a quick, easy 50, 60, $70,000. And I don't want to use the word easy because you got 6 to 9 months worth of work. You got to pay attention to people. But my favorite strategy became short-term rentals. Short-term rentals is the reality that I can control a property by either buying it or leasing it and basically renting it out to individuals who might hold it on a daily basis or 2 or 3 days or 4 days because they're vacationers. You guys might be familiar with it. in the form of people using properties like Airbnb and VRBO. Those are common platforms that you can find somebody who's interested to be somewhere in a short period of time, and they pay you a daily price, a per diem price, and you can make it better than the traditional rental. Or if you buy a commercial property, that means you are in some sort of commercial zone where there's a laundromat and there's some sort of daycare, or there's some sort of grocery store. Generally, the person might own the entire property and they're going to rent it out to those particular businesses over a 5 to 10 year period. And this is how the most common way that people actually make money. But some of the challenges and risks that I personally ran into, and I believe a lot of other investors may also have run into the same concept, is that essentially, in order for you to get involved in real estate, outside of some of the grant programs and things that people can definitely take advantage of, generally you're going to come up with your own money coming out of pocket. Meaning that those grant programs and things are great, but essentially it's subject to how you qualify for them. But a majority of investors are using either their own money or somebody else's money so that they can put a down payment, and then they got to leverage the bank's money. They're going to leverage a Wells Fargo. They're going to leverage a Chase Bank to borrow money, or a traditional mortgage company. So essentially, when you do this, you'll begin to realize that if you are an investor, you're going to have to come up with a fair down payment. Most banks want somewhere between 15 to 20% of down payment. So depending on the price of the home, if it's $100,000 and is a 20% down payment requirement, you have to put $20,000 down, and the rest of it you're going to get from a mortgage. But you got to pay attention to values and where you're buying it, because there's such a thing as market volatility, which means that the values of property can decline over the course of time, or specific periods or periods of a year, depending on where. But recently, we've seen a lot of values constantly increasing because there's not a lot of inventory. But when inventory shows up in the market, it really means that prices can eventually decline depending on how many buyers are looking, or how many people are not looking. But one of the things that I ran into, or a lot of investors or individuals say, hey, you know what? You can have a great set of tenants, but you can go through some major issues with the wrong individual over a period of time due to loss of job or their inability to be very disciplined about paying rent. And you can run into late payments, or you can run into property damage. You can have the same best tenant who's paying well and they're on time, but there are maintenance issues that you have to become responsible as you do more real estate. Then there's what I call liquidity challenges or liquidity issues, meaning that in order for you to access your money at that particular transaction or deal, you need to either going to get yourself a line of credit, or you're going to have to do a refinance, which basically means you're borrowing more money. There's things like taxes that need to be paid, property taxes, or when you sell, there's what they call capital gains taxes. But I tell people those things can be addressed, because if you're bringing in enough income, that can work out in its favor, but it's just a true expense tied to real estate. But one of the biggest things that I begin to run into is the understanding of time and management responsibility, meaning that the more property that you have, the more responsibility that you have as far as some of the things that need to be managed and how much time might need to be invested in that reality. And even if you have a great management team, you're still the owner. You're ultimately liable for anything that can go positive or negative. So you just have to learn to be involved and be consistent about what you're doing. So once you understood that, one of the things that you really want to be clear about when it comes to property is, hey, what type of mortgage do you have? Meaning that one of the first places people look at is their actual interest rate. And essentially that is great because maybe you decrease the actual amount of expenses that are tied to it. But every mortgage has two things that you got to take into consideration, which is mean that how is interest being charged? But generally in the mortgage world, the interest is not in your benefit. That's in benefit of the bank who's actually collecting money on you, which is not illegal in America, but it's an understanding that you should have. And I tell people there might be a leak in your real estate transaction, or there might be a leak in your mortgage debt. And what I tell people is that money becomes valuable to understand that, hey, based on the interest that you actually might be paying on a particular property, you could be losing the opportunity to use that money or based on the down payment that you put into a property, you could lose the opportunity maybe to do a smarter investment. So I tell people, even if you actually have a mortgage debt of 5%, which just basically means that's a pretty good rate back in the day, and now some people may have a lower. What you really want to begin to understand, when I started to study the amortization schedule, I began to realize one thing. If I borrowed $300,000 and my interest rate was about 5%, it basically meant that, hey, I would have actually a beautiful mortgage payment of $1,610. That's not bad. It's better than most rents these days. But there was the amortization schedule that I realized that a lot of people would either giggle at a closing table or maybe not even look, because the schedule told two truths. Number one, yes, you can borrow my $300,000, but if you hold this property for a 30-year period at an average interest rate of 5%, you are literally going to give me $279,000 and $767 in interest over the course of time. That means I would literally pay that bank over a 30-year period up to $579,000 between the principal and interest. Not a bad deal if that money came into your pocket, but it's literally money that goes into the bank. Now, most investors might say to me, hey, Hans, I'm not going to hold my property for that long, but the math still works out to sometimes be the same. See, when I would run the math and I say, hey, I got a great fix and flip and I made $70,000 or $100,000, what really meant to say was that what does the math really say? Meaning that after the expenses and interest, because if you look at an amortization schedule, it's built for the bank to win. It basically says that, hey, you make me a $1,610, but I'm going to divide that payment into two pieces. I'm going to say, hey, a portion of it's going to go to interest and a portion will go to principal. Now, this is not illegal in America, but it's a truth. It just basically means that if you understand the math of your money or how the money works in your particular project and what you do, now you become a little bit wiser, because it doesn't mean a mortgage is not a tool, but there's a truth. It means that, hey, the average mortgage payment, they'll end up collecting an average of at least 78% of that money, of the $1,610 in interest. So over the course of time, even over a 3 to 4 month period, you could still spend $3,770. Now, the smart thing that we would do as investors is say, hey, that's great, but if I can make over and above this interest. But I tell people, as you begin to understand how money, you see how you're either winning or how you might potentially be losing opportunity depending on how you're structured in a deal. So the reason why I got excited about an index universal life is that I understood that that could be another wealth building alternative. See, wealth is the idea that you're going to take those income and those profits and you might put it in a real estate deal. You're going to take that income and profit that you made in the business and you might potentially look at an index universal life. Now, why would you do that? Because an actual index universal life is an actual life insurance policy. It's actually a form of a permanent insurance policy. But the unique thing that always captured my attention in any type of policy that was permanent, like a whole life, until I got introduced to how an index universal life was cash value accumulation. Write two things down. In America, you should understand cash flow. Cash flow is the rental income that you're receiving, and you should also understand cash accumulation. See, in an index universal life, there's a component where you can accumulate cash, and it's going to be based on you earning interest tied to certain stock market performances. And maybe one of the most common stock market performances that everybody understands in America is an S&P 500 fund. In the S&P 500, it's just basically the top 4 to 500 companies in America that are doing well. And based on that performance and how it pays, it will increase the value of your dollars in interest. But the other reason why Index Universal Life got my attention is because if you understand the value that it can create, you now begin to understand that you can create access to money in a form of a tax-free withdrawal, or you can create yourself cash flow in distribution. See, when I bought a property or I leased a location and I was going to create cash flow, I essentially was trying to make sure that I could create some sort of rental income. but I had to find the property. I got to go through the negotiations. And when I understood what an index universal life is, it's an account that you can establish that creates two forms of value. First of all, because it's a life insurance, if unfortunately somebody was to pass away, it will pay out a tax-free benefit. But over the course of time, I can increase the value of my cash and accumulate more money based on the interest. So it does have a death protection. It does allow you to leverage the ability to grow the value of your money in that account. And I call that a benefit appreciation. That means that over the course of time, based on the value of your cash growing, you will create a benefit that not only increases your dollars, but it also increases the benefit depending on how it's organized for the value of the life insurance to go up over the course of time. But one of the key things that you should be aware of is that, hey, while you get a chance to participate in the market, there's the ability for you to have what they call downside protection. Because depending on where you put your money at, you could be in a position where you could potentially lose it. But in this case, a index universal life insurance policy has this component called a zero floor, which creates protection for the dollars that you're contributing to the account that covers the cost of insurance and the value of the dollars that are growing in that interest rate. One of the things that you should study tonight is look at the IRS code 7702. What that code really says is that this is the way that you can legally create a tax advantage leveraging a life insurance policy. And if you begin to understand that, now you can position your dollars to either accumulate, create retirement planning, or create cash flow. So as I begin to understand that, it became very attractive because I learned one thing in real estate, which means that nothing's wrong with that wealth strategy as long as you understand how it works. But how competitive could you be if you understand alternative strategies, which means that when I bought real estate, if I had to buy a $500,000 property, I got to put $100,000 if it's 20%. If I'm buying a $100,000 property, I got to put 20%. That's 20 grand. So depending on the size of the property. Now, what's happened here in New Jersey and certain states like California and the high-end states is that the cost of living has changed. So that means if you are an investor, you are also experiencing that reality. But if you do a quick comparison, I buy a property for $500,000, I put $100,000 down, then I still got to go visit Chase or Wells Fargo. Or I got to get to my local lender who's going to borrow me $400,000, and I better be paying attention to the amortization schedule because there's a leak of interest that's going directly to the bank. One of the reasons why this continues to capture my attention is that if you begin to realize that in the game of life of understanding how money works, if you begin to understand that money is actually a currency, it should be either moving towards you or working for you. If you don't do those things well, it will work against you and it will actually go away from you. But I begin to understand the math of what I'm doing by saying, hey, I am going to have to borrow $400,000 from a bank. I am going to be able to create rental income that's going to cover the mortgage expense and the tax expense and some of the insurance liabilities that are tied to owning property. And then I might net a certain amount of money, about at least $1,000 or more, depending on the property. This is an example of this property gaining $24,000 worth of income through rental income. And after expenses, there's about another $1,000 per month that can be distributed. So that means if I wanted to make multiple sources of income, I have to have multiple properties depending on the margin that I would make. But I tell people I still have to attend with some of the risks. I had to deal with market risks, either tenants or values changing. I still needed to deal with taxation, which means that if I sold or if I maintain the property, I have property taxes. And I still had to keep in mind the forms of way I can access the money because liquidity is possible, but it's very different in real estate. It's based on either your credit being great or your ability to access a line of credit or your ability to leverage a refinance, which means that you're borrowing more money from a bank and your amortization schedule changes in your favor. But I don't want to be unfair to real estate. Most people are in it because they're going to create value. If you understand where you're buying and you understand what you're doing and you understand that math, you can create new forms of value, which means that the appreciation value of your property will grow. But if I did the same very thing with an index universal life, I would say I can put $100,000 into this type of account. I can A, create a life insurance benefit. B, I can create value of my cash that's been contributed to that account, but I wouldn't need to actually borrow any money from a bank. I literally can create a situation where I can leverage the same dollar so that I can create what I call income distribution, depending on how you organize it, or B, at minimum, create what I call a growing value of cash, leveraging the opportunity to grow my money over the course of time while creating value. The other thing that I begin to understand is that, you know what? I have a zero floor strategy, so I don't have to be concerned about market loss. I got to structure the account properly because I'm looking forward to create what I call cash distribution. In a index universal life, you can create a form of tax-free distribution, leveraging loans from that account so that you can position yourself. See, in real estate, I understood the same principle because essentially, maybe before you sold the property, you could borrow money against it so that by the time you sold the property, based on what you borrowed against it, it gets paid off in the sale. But that money that you borrowed, that you kept in your account, you walked away with it tax-free. That's why the principles of this stay true in the same idea. But I also realize I can increase the value of my cash over the course of time, and I can leverage money for other smarter things, which means that based on how you structure in the universal life, you have access to the cash very quickly over the course of time in less than a 3 to 5 day period upon request, depending on the value of the cash that's in the account at that time. And I can also grow the value of my life insurance portion and cash, depending on how you structure. So it got my attention. So I realized very quickly a IUL generates what I call wealth. What is the principle of wealth? Wealth is the idea that the money that you place somewhere is actually making you more money, or at least at minimum creating you a benefit. And I realized very quickly that if you structure these accounts correctly, you could leverage a form of cash flow. You can position your dollars to grow tax-free, which means that you can accumulate gains. Gains is more interest or more value. Hey, this year I had $1,000. Next year I got $1,200 in that account based on $200 worth of more interest. I can not experience any market losses. I could leverage it just like real estate. See, the main reason most people go into real estate outside of the idea of being in a beautiful home that they enjoy, which is perfectly fine, but most investors are saying, how can I increase the value of my cash? And you can begin to do the same thing. You can now create what I call a self-financing system. Leveraging real estate goes two ways. While I'm growing my cash, I can use the money for other smart investments or even personal use, meaning that if I have a problematic tenant and they're no longer paying, but I still have a tax responsibility or a mortgage payment responsibility, because I was building this second bucket of cash, I have access to it, or I can create what I call a passive income source. So I told people one of the things that my wife and I have been chasing very well is like, how much more income can we create without having to actively be 100% involved in it? And once you understand how to structure these accounts, you can create these as an opportunity for retirement planning, meaning that at the beautiful age of 52 today, at some point when I turn a certain age, there's going to be a place in my life where I want to make sure that I can generate income and I want to leverage my ability to retire. It doesn't mean do anything, but it means that I can control my time. And you teach people how to do that by making sure that they understand how the money works in a particular deal. So when I begin to understand that I can overcome some liquidity challenges and or reducing my risk or creating certain tax efficiencies or creating a long-term security by creating cash value and allowing the value of my dollars to grow, and I can position myself against the downturns that can happen in the real estate market, or I can leverage this for estate planning. One of my favorite words is legacy because it's something that I've also been discussing within our family, which is the ability to position you, your family members, the children that you care for a future that is unknown, but you can position the dollars so that you can leverage it. And one of the things that I tell people that you want to learn about leveraging a life insurance policy, it's what I call a probate jumper. If you're familiar with probate, that means that generally, when you're dealing with even property, if you don't properly organize those details, or if you don't have a way to situate it, you might have to face a judge so that it can regulate how the intention was, because a will is really just a letter to a judge. It's actually a way for you to literally go directly to a judge and say, what was Han's intent? But when you have beneficiaries set up on particular types of policy, that is a direct tax-free check that's being positioned in favor of that. So let's close with this. What if you actually took the understanding of real estate that you may have if you're a real estate investor or like myself, and you actually combined and leveraged both strategies? Because wealth is a strategic idea of how you grow your money. So it doesn't mean real estate doesn't work, but if you understand it and some of the scenarios that I just shared with you, you could actually marry some of these. And I've seen people do both because they can use the IUL to fund more real estate investments. You need cash for down payments. You need cash to be financed for the property, but you could possibly do that, growing the value of your dollars over the course of time, or positioning the money that you're making so that you actually can become the lender. You can protect yourself from some of the rental challenges that can come in. That means you can leverage your cash value in the event of a tenant not paying or particular challenges or maintenance issues, because you have a bucket of money that becomes available to position yourself. And then you can also build yourself what I call a guaranteed strategic tax-free fund for yourself alongside the real estate that you're growing. See, the wisdom of understanding is the power of beginning to leverage information in favor of you being able to create more wealth, or creating more opportunity, or creating more cash flow, and then you can actually create a legacy. See, if you understand the math of how money works, or if you understand the math of how a real estate transaction is, or the math of an index universal life, you can begin to combine these strategies to leverage your dollars in favor of more growth. So a peer of mine said, hey, Hans, I'd like to understand more. And he says, what if I gave you $500,000? How would you strategically place it so that you can grow the value of my dollars based on the concepts of leveraging an index universal life? I said, well, here's what we're going to do. We're going to strategically take the $500,000 and dump it into this account and contract over a 5-year period. That means every year we're going to contribute $100,000 into the account. And one of the first benefits that you should be aware of is that, hey, if unfortunately death was to visit your door for some unknown reason, we would automatically be able to pay your family at least $2 million based on the contribution that you made in that account. And that would be a tax-free death benefit. Every year, the value of your dollars outside of the cost of insurance will grow in value. And then along that period of time, it will become available in the form of ways that you can access in the loan. By the time you get to the 5th year, at age 39, you would have contributed $500,000, but by that 4th and 5th year, you would have gained $27,000 more in interest based on the type of account that we would leverage to grow your dollars. That means even on the 6th year, you'd have $55,000 more than what you currently have. Plus, you'd have access to up to $534 to $567 in dollars that could be leveraged. So that means that first year's $100,000 can easily be accessed in year 2, and then year 3, year 4, year 5. And you can leverage those dollars to do more real estate transactions, or you can grow the value of your dollars over the course of time. And he says, well, how does the income portion work? I said, well, what age would you feel comfortable in taking out income? Because there's options here. He says, what if I took out income at age 55? Because you said you can create a lifetime source of income. I said, yes. Well, based on the value of you having access to $1.2 million in growth value by the time you turn 54, if you decided to take it out as income, they would guarantee you a lifetime income of $106,000 tax-free. Because you're leveraging the dollars in the form of a loan, they would distribute that against the collateral of this insurance policy, and you would have that form of income. So I tell people, if you begin to understand how money works, then you can position yourself. So this works beautiful for those that are either real estate investors or anybody who really wants to structure an account where they can create value. I've talked to business owners who can position themselves to create what they call a tax-free solution, because maybe they were highly interested in real estate, but based on timing and the ability to find property, they begin to say, what's another way that I could leverage the same type of contribution in a real estate transaction and leverage it in an index universal life structure? For those of you who are really earning a tremendous amount of money and income, you can begin to position that extra income to create some tax-free benefits, leveraging an IUL or leveraging the solutions that can position you to create cash flow. Or maybe you're a retirement saver. Maybe someone has put a nice nest egg of IRAs together, 401ks, or other values that you've created over the course of time. And maybe the day-to-day idea of finding real estate is not up to thought process, but you can create another value of cash. So what we've done here at Our Infinite Company is we're teaching people how money works and how they can leverage different strategies or how they can marry different strategies. So if somebody's invited you tonight, be thankful that they have. Now get in contact with the individual who's invited you to this call. And what they're going to do is they're going to position you to sit down and talk about how can we create a cash flow strategy that benefits you? Or how can we help you potentially get started with a strategy called an IUL if this is something that you're interested in doing? So what they'll do is they'll sit down with you, they'll create a session so that they can review with you what your options are, how much money are you strategically thinking about considering, so that way you can understand. So do me a favor, get back in contact with the individual who's invited you tonight. Tell them thank you, number one, for positioning you in this conversation, at least to understand what your options are. But if there's any questions tonight, I'm going to open up the line for anybody who would like to ask a question before we wrapped up. I pray the information has been very valuable to you, and this could give you another way to strategically how to leverage the money that you're growing, or strategically start a process for you to grow money, even if you're not a real estate investor, even if you just haven't built up your retirement savings. We can show you some of the options that work for you. But thank you for those that have attended. Is there any questions before we wrap up tonight? So that way I could try to answer and make sure that everything has been clear based on the information that I shared to you. Let me take a look in the chat. Thank you, Mr. Hawkins. I appreciate that. All right. I respect and love everybody who made it tonight as far as being able to get information. Get back to the person who's invited you. I look forward to you. Please feel comfortable in inviting your peers and individuals who would like access to this information. We do this every Thursday evening around the same time, and look forward to being able to serve. You guys have an excellent, excellent evening. Thank you very much. Thank you.